Hello, everyone. Today on the Final Bar, I'm talking to Javed Mirza from Canaccord Genuity in Toronto. We'll look at some of the big picture charts that he is paying attention to. A lot of volatility, a lot of choppiness today. This is a familiar look with the Dow higher, the Nasdaq lower, the S&P sort of flat right in the middle, not really making any headway in either direction, settling in just above 44.60. Sort of a defensive feel to the tape today, though, with real estate consumer staples at the top of the list. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the technical analysis toolkit. Had a lot of fun this week talking with a number of my fellow members of the CMT Association. It's the big annual symposium coming up next week, actually in Washington, D.C., and comparing notes on this market environment. It's been a choppy period. And the general takeaways I would tell you, it is a choppy, volatile period. There's a lot of uncertainty, but it's markets are often labeled a stock picker's market. I think this is one of those times where it's really absolutely true. You're finding stocks that are working just fine. You're finding style like energy materials. You're finding stocks like Peloton that are testing lows. Even names like Netflix blowing out of support and pushing downward. We're going to look at some of those names in particular. We have a segment today called The Bottom Line, where we'll look at some of the companies reporting earnings this week. A number of key names, not just Netflix, but some of the stocks in industrials, healthcare, even some financials with some charts that I think could be worth reviewing just to get a sense of how this earnings season is really starting to play out from a technical perspective. We have great guests on the show. I'm excited to have Javed Mirza join us on the show once again here shortly. Tomorrow on the 21st, we have Tony Dwyer joining us once again, giving a big picture perspective. We'll probably end up talking about the Fed, inflationary pressures, how that relates to the charts that we're reviewing. Next week, the beginning of the week, the Final Bar team is going to be on the road. We're actually going to a conference in Las Vegas, and we'll be off Monday, Tuesday, Wednesday. We'll be back live on Thursday, the 28th, featuring Jeff Huge from JWH Investments in Minneapolis. Let's continue on today's show. Go to our market recap. We're in the meat of earnings season here. So as always, I'd encourage you to keep a note of some of those key names in your portfolio or, big names that have market moving potential just to see how they're playing out. Because as we can see from the chart on Netflix today, big gaps can happen when earnings disappoint or surprise to the upside. The end of the day today, the S&P was flat, essentially 44.60, right around that level for the close, but really just sort of chopped around through most of the day. The Dow higher by about 0.75%, the Nasdaq lower about 1.25%, really finished toward the lows of the day here. We're going to look at a chart of the Nasdaq composite in a little bit because it's at sort of a concerning point, I would say. It's one of those charts that could look bullish or bearish depending on what your take is. And I'd encourage you to use some techniques, use some charts that get you away from what that's called. It's called confirmation bias, where you sort of make the decision first and look at the chart. I'll show you what I mean on the chart of the Nasdaq here in a few moments. Mid caps and small caps, by the way, both up today and outperforming the S&P. The VIX back down right around 2050. Interest rates coming off a bit today. So yesterday and recently, the 10-year and the 30-year have been nearing that 3% level, which is a pretty significant benchmark, a pretty significant milestone for some of these rates that have not seen the 3% level in quite some time, but coming off a little bit today with 10-year yield settling in around 284. The dollar index down a little bit, although we've talked about that structural uptrend in the dollar for quite some time and what the ripple effects of a stronger dollar environment can mean. Elsewhere, gold and silver had a really rough day yesterday with the GLD down fairly significantly, bouncing back and recovering about half of those gains today with the GLD up about 0.5%. Commodities overall, which struggled yesterday as well, regaining some of those losses from yesterday. Finally, crypto land coming off a bit. Both Bitcoin and Ether are the two main coins that we tend to follow on this show. had a nice run earlier in the day, but coming off today with Bitcoin currently just above 41,000, Ethereum remaining above that 3,000 level, but not too far above that key point. Let's look at a chart of the S&P, and then we'll talk about the Nasdaq Composite next. On the chart of the S&P, I was recording a video earlier today for my YouTube channel called Market Misbehavior. I'll post it here in a couple hours. But basically doing a choose your own adventure style discussion about the S&P 500. I could think through, and I would encourage you to think through some of the different scenarios. What would it take for the S&P to retest all-time highs and not move a little higher? What would it take for the S&P to get down to 4,200, 4,000, even 3,800? And I know what it would take is the price would have to move a lot, but think about what that would do to your current portfolio. Think about what levels of risk you'd need to define, how you would manage stop losses, when you would start to rotate positions, given some of those potential outcomes. And it's what I call a probabilistic analysis. What's your most likely scenario, but what are the other potential scenarios that you can see on the charts, and think through some of those. So in the short term, you see the S&P has settled into sort of a narrower range with around 4,600, 4,625 at the upper end from late March, and now bouncing off of this level around 4,375, 4,380. Those are both right around Fibonacci levels, which is kind of interesting. And the real question is, which one of these will happen first? Do we get above 4,600 and stay there? Do we get below 4,400 and remain there, right? Which way do we break out of this potential range? I'm not sure at this point. If you had to ask me to pick, I would probably say we break down before we break up, only because I see this bounce as a bit of a counter trend move within a downtrend that we've seen in stocks overall. But again, the charts are going to tell us what those signals are, and what those signals potentially are, what we would need to see to change a perspective on things. Let me get to the chart of the Nasdaq Composite. We'll look at this one here. The reason why I think it's an interesting one is I had people back here sort of in late 2021, really in November, December, asking whether this was a head and shoulders top. And my answer was maybe, right? I mean, it's a head and shoulders like pattern for sure. And, a classic textbook, really clean head and shoulders pattern is where you have a clear high surrounded by two lower highs. You have a clearly defined neckline, meaning the lows between those three high points. You break the neckline and you measure the move downward. So you could call this high in September, the high in November, really was sort of a double top there. And then the lower highs here on the right as the head and the two shoulders. You take the neckline there, which we clearly broke in January, and that measures basically the height of that pattern, which actually takes us not too far away from the January and February lows. If you look at what's happening now, though, you get a bit of a head in what's called an inverse head and shoulders pattern, right? A low surrounded by two higher lows. Now, I'll tell you right off, this isn't sort of a textbook classic pattern, because really you'd want a single head, right? You'd want a downtrend where a new low is then finished by a higher low, and that completes that inverse head and shoulders pattern. This is a little funky, kludgy, if you will, with February and March being sort of double bottoms. However, I would tell you, if the Nasdaq Composite gets above 14,500, or even better, above 14,700, which would be the 200-day moving average, that would certainly cause a lot of people to recognize that head and shoulders like pattern. And that would suggest a return at least to all-time highs. That would be 16,000 plus for the Nasdaq Composite. The reason why I want to show you this chart now is I would caution you from calling it a head and shoulders pattern now, or really an inverse head and shoulders pattern. It's a common mistake to find patterns that are not really there yet. For this to be a valid inverse head and shoulders bottoming pattern, you would need to complete the pattern, which means you actually have to break above resistance. Until that happens, until the Nasdaq Composite gets above, we'll call it 14,700, it is not a valid head and shoulders bottom yet. So patterns begin to emerge, and then the trigger, the validation, is when you actually break the neckline or break that resistance line that defines the pattern. So could be a head and shoulders bottom pattern emerging, but not quite yet. Let's look at the rest of the indicators telling us about the current trading day. So as I mentioned in the introduction, quite a defensive feel to the tape, with real estate, the number one sector out of the 11, up 1.8%, followed by consumer staples, followed by healthcare. I mentioned on yesterday's show, earlier in the day yesterday, we recorded some of the content for our upcoming stock charts draft. By the way, you can go to stockcharts.com/stock draft to check out that the information on that the 8 team managers who each picked a team of 2 stocks, which will be airing at the end of next week. What was interesting to me is there was quite a defensive feel, particularly at the beginning of that stock picking exercise. And this is a group of experts looking out about 6 months. I would encourage you to check that one out when it airs next week, because I think you'll be surprised to see which of the names in the S&P 100 were actually selected. On the bottom of the list today, it's the three sort of fangy stock sectors. You have communication services down over 4%, consumer discretionary next, and technology essentially flat, but clearly underperforming through the course of the trading day. What's interesting is even though tech was flat for the day and the FANG sectors were down pretty bit, you have quite a bit of barbells looking at some of these different stocks. And we're going to get to a little more of this in detail later in today's show. We have a segment called The Bottom Line. We'll look at some earnings names in particular, but I wanted to highlight just two of those right now because obviously they have pretty mega cap names with some market moving potential. IBM with a nice quarter and a nice bounce with the stock up 7% today. That takes it right back up to previous highs. I'm actually going to take the adjustments out of the data. So you put the little underscore in front of the ticker. Now we're unadjusting the data. And this is one of the reasons why I wanted to bring this chart up in particular. When you just type a ticker IBM, it's using adjusted data, which means it's smoothing out the data or adjusting for dividends. So a company that pays a big dividend like IBM, once a quarter, the price of the stock changes to adjust for that dividend payout. So a lot of people look at the stock price, but stripping the impact of the dividends out. And that is our default on StockCharts. But if you put the little underscore in front of it, this is showing you where the price actually traded, where the stock actually traded, going back historically over time. And you can see we've rallied to the highs for 2022. We're sort of right in that sweet spot, 138 to 140, maybe 141. I'll be looking to see if IBM can regain those previous highs, which could clear the way to all-time highs in June. We need to take a quick break here. We'll be back with today's guest, Javed Mirza. We'll talk to you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close here on our show. A couple quick comments before we get to today's guest, Javed Mirza. First off, we welcome your questions. We had a great mailbag segment yesterday talking about filling gaps, talking about doji versus hammer candles and how to think about them. We are here to answer your questions about technical analysis, market dynamics, whatever it is. Send it our way. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show of this week. Also, go to StockChartsTV.com. That is our on-demand platform. It is totally free. I was chatting over email with Larry Williams earlier. He did a fantastic special event last week for us on StockCharts TV. That is available on demand. All of our great guest discussions with, capable analysts and knowledgeable market practitioners like Javed Mirza and many others at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. I want to welcome on today's guest, Javed Mirza. Javed is the technical analyst at Canaccord Genuity, coming to us from Toronto. Javed, it's great to see you. Thanks for coming back on the show. How are you?
I'm doing well. Thanks so much for having me back.
Yeah, it's great to see you. And we were chatting before the show. I mean, there's obviously a lot happening in the markets, and there's certainly a macro feel. I think a lot of people are just trying to get their head around the macro environment and what it means for their portfolio. You're starting us with commodities, which have certainly had an incredible run over the last year or two. What's your take on this space now?
So up until now, you can see those two red dotted lines, just highlighting that downward trend channel that commodities have been in since the end of the secular bull market in commodities that we had from 2000 to 2010. So just to step back, the last two secular bull markets in commodities, so 2000 to 2010 and 1970 to 1980, were coincident with secular bear markets in equities, effectively a 10-year sideways trading range. So you've seen this breakout here in this trend channel, and originally our view, and if you recall, when you and I last chatted, we were talking about this 4-year cycle reset, which is every 3 to 5 years, the market goes through the contraction phase of the business cycle. And our concern was that that was going to take place at the end of last year or the start of this year. So that's what's happened. But there's a bigger concern is that we're shifting out of a secular bull market in equities and into a secular bear market in equities because of the strong move higher here in commodities.
Your second chart, going along that way is the S&P 500. We talked in our market recap just about some of the short-term movements. This is a longer-term view on the S&P. What is this telling you?
Yeah, so if you take a look at the right-hand side, look at those green boxes. Those are four-year cycle resets, or the contraction phase of the business cycle. Typically happens every 3 to 5 years. The damage in terms of percent or magnitude is around 15%, typically lasts 34 weeks. Here's the problem. Take a look on the left-hand side. Those are four-year cycle resets, those red shaded boxes, during a secular bear market in equities. So the problem here is if we're shifting into a secular bear market in equities, we're not even halfway through this corrective phase. That's the issue. We could be down 30% by the time this is all said and done, and that could be sometime in 2023.
It's such a great point, and it's funny. I feel like when we start to pull back at the beginning, it always looks like a quick, brief correction, but longer term corrections often start that way, and then they don't end, right?
That's a very insightful comment, Dave. I'll tell you why. Everyone has seen that chart. That chart that shows a motion and then peak. And then it's that the first bear market rally is, I forget exactly what it's called, but it's that hope. And that's exactly, you nailed it, Dave. That's that, oh, this is just a correction in a bull market. But what people aren't picking up is that shift in transition. And one of the areas of the market that we'd be really watching here and that we highlighted to clients at the start of the year, it's that four-letter word, it's gold.
So we've touched on commodities. Gold's certainly starting to show some strength. It's a lot of perspective, a lot of focus on interest rates with the Fed starting to raise rates. We're looking at the 10-year yield here. Finish us off with this chart.
Yeah. So and here's the other big issue. Going back to what we talked about, that secular bear market in equities. If we move above 337 on US 10-year yields, and I think that's going to be a stalling point. Notice that we touched that in 2003, 2010, 2011, and it was resistance in 2019. But the bottom line is, if we move above 337, we're seeing a definitive downtrend break. And this is just a 40-year chart. I have a 100-year chart where you really see it clearly. And maybe we'll talk about that next time I come on. That is a big trend change. And we could be seeing the sell of a generation in bonds and the break of a 40+ year downtrend. And that's the thing, the final point I'll leave you with, Dave, is that people think of technicals as for trading and 5-minute chart, 10-minute charts, and they're really missing the big picture to really step back and look at these 40-year, 50-year, 100-year charts, and they will tell you so much. And the key is you always want to be on the right side of those longer-term trends.
I love that take, Javed, and a great way to wrap that up. It's I appreciate you sharing some of these charts and especially the long-term perspective on what's happening here. Stay safe there in Toronto. Be well. We'll talk to you again soon.
Thanks, Dave.
That's Javed Mirza. Javed's the technical analyst at Canaccord Genuity in Toronto. What I love talking about, talking with people like him is just this long-term perspective. And I know from my own time as on the institutional investment side, I was struck from when I arrived in that sort of environment, how much of a focus on long-term charts. All of a sudden, we're looking at 20, 30, 40, 100+ year cycles because you're trying to understand the big secular trends and understanding how the short-term movements relate to those long-term trends can be incredibly valuable. That's a great take there from Javed Mirza, and I appreciate him sharing some StockCharts long-term charts, showing us how we can use the platform to get a good big picture sense of things. That was great. Let's continue on with our next segment called Power Up. What we like to do with some regularity is highlight some of the recent updates to the StockCharts platform. We've just started a pretty aggressive release cycle for 2022. Every 6 weeks or so, we're going to be putting out a new version of our website with some additional information. I just want to share with you one of the things that we've released just in the last month or so. And this is all related to the ChartList system. So when you look at your dashboard, you'll notice there's a gray button at the top that says ChartList. If you get down here, you can see I have an insane, probably unwieldy amount of ChartList. Actually, our founder, Chip Anderson, convinced me to lighten up a little bit because I just had an unwieldy amount and I was starting to lose track of things. But this is a great way to take any list of stocks, ETFs, futures, commodities, whatever tickers you have, and keep them in meaningful ways, right? Put them in order and start to sort them and understand them in a better way. I'm looking at a chart list just using the Dow 30 stocks as a sort of a temporary universe just to give us a sense of things. And at the top, once you bring up any of your chart lists, you have this little drop down button on the different ways that you can view your list. And you'll see this little green box on a couple of these because these are new visualizations that we've created. First off is what's called scroll view. Now, I regularly look at the entire S&P 500. I actually do it every weekend, and I've done it for a number of years. It's a fantastic way I have found to just go through every chart in the S&P, make sure I've seen it at least once a week, and make some notes about some of the major takeaways that I got from that. What happens with this new scroll view is depending, no matter how many names you have in here, 10, 30, 100, 1,000, you can scroll down, and as you get to the bottom of the page, it will start to add on and give you more and more charts on your list. So as you go on, you can go through a huge list of 500 stocks, just keep scrolling, you get to the bottom, and you have a perpetual scrolling list of all 10, 50, 100 plus charts that you have in your chart list. As you go really far down, by the way, we have this little arrow key in the bottom right corner of the website. So you pop back up to the top of the list if you want to go somewhere else. The second one is what's called symbol summary, particularly during earnings season. If you have a list of stocks and you want to know which ones are reporting earnings, when that date is going to be, and particularly looking at after hours trading, this is a really good way to do it. Our simple summary page incorporates some of the fundamental data that we have on the platform, like valuations, and also some technical data when they report earnings and so forth. At the top, you have these arrow keys, so you can quickly go through a list of stocks in your portfolio or a list of names, and you can get some of the particular information. And it's really helpful around earnings season to see how things are trading after hours related to their earnings release. Finally, a performance tree. This is something we've had a lot of requests for. And once you have a list of tickers in here, we have some performance data. So you can click on any of the column headings to sort ascending or descending. We have some pre-canned timeframes that were most commonly requested. The next version of this will actually have a custom date, so you can actually look at performance from a particular start date. But overall, this can be a really good way of taking a list of names and quickly drilling down into the performance characteristics. Which stocks are getting it done? Which stocks are struggling over a particular time frame? So these are three new ways that we've just added in the last couple of weeks on the StockCharts platform to help you break down a list of stocks using our chart list features. We have a lot more really cool stuff to come in our future shows in the Level Up segment. We'll share some of those with you every week. Let's continue on with our next segment. The bottom line, as I mentioned, a lot of earnings coming out this week, and we're sort of in the meat of earnings season. This is one where I take my Stock Traders Almanac, which is where I usually jot which tickers, which companies are reporting, and make sure that I check out their charts going into earnings, coming out of earnings. Just think about that relationship between the quarterly earnings report and the charts. I have to start with Netflix. I was asked by a number of media outlets over the last 24 hours to sort of talk about the performance of Netflix. And, obviously a big disappointment, first negative subscriber number in a decade, 2.5 million subscribers positive was the estimate from the company not too long ago, ended up being a net negative 200,000. That is not a good look for a streaming service for sure. And the chart, of course, really struggling. In the aftermarket yesterday, it was down about 25%, opened even lower, and closed the day around 35% down from yesterday's close. What I encourage you to do when something like this happens is when you get off of the range on the daily chart, remember that you can look at other timeframes and looking at the weekly data. I'm glad Javed Mirza was sharing some of the longer term charts. I would encourage you to do that on some of these names, because when the price really changes, you want to understand where we're at right now relative to the big picture, right? Where's Netflix at relative to where it's been? What's interesting to me is after this drop, we're right back in this range that we were in 2018, even 2019. We spent a lot of time in this range, sort of this 225, 250 range, which is back here in late 2018, in sort of fall 2019. We can see after this drop, we've gone right down to this level. Now that we've had a gap on the chart, it sort of goes back to the playbook from, meta platforms earlier in the year, even Netflix. See if it's able to fill that gap. Do you find stability? Do you find buyers coming in now that the valuation of this stock has been reset about 30, a third of its value, or third lower than it was as of yesterday's close? But I would pay attention to those lows from 2018, 2019. The markets have memory because investors have memories. Let's see how the stock trades relative to that long-term support level. I also want to mention, just because, excuse me, we've talked a lot about some of the cyclical sectors. We're looking at industrials recently. This is the chart of LMT, Lockheed Martin. This is, I think this was right after the, this before the open on Tuesday. And you can see it's actually come off a little bit. What's interesting on the daily chart of LMT is you can see we're sort of testing resistance. We had a high watermark around 480 in early March, pulled back a bit, and then retesting those highs. This week, a bit of a disappointment in terms of the numbers and the stock coming off again today, down about just over 1%, but potentially setting up a double top. I think the bull case on something like Lockheed Martin obviously would include getting above those that resistance level. So interesting that a level of resistance tested, now holding. Earnings is pushing the price back below there. We get above there, and this starts to once again become more of a constructive chart, but it has to regain those highs, I would argue. I would also point to you some of the healthcare names. We're looking at Johnson & Johnson here. This is Procter & Gamble, PG. These are both names. PG was before the open today. Johnson & Johnson yesterday. Both stocks having a nice run higher. PG is actually testing resistance now. So if you look at the highs from December, January, February, all right around the level we've now rallied up to. I think this could be a very constructive chart if we're able to gain those highs and hold them. So 165 could be an important level to watch there. Just to wrap up the segment, then we need to wrap the show. Tesla reporting after the close today, just checking the numbers as we're recording this right after the close, bouncing a bit up about 3.6% in the aftermarket and going right above 1,000. And the chart of Tesla, big round numbers often have meaning. We've been right around that 1,000 level. It can get above there and hold it. That might be the new level of support to be watching on a key growth name. We need to wrap the show, folks, and go to the 3 and 3 charts in 3 minutes. Some of the key visuals to make sense of this market. Here we go. Chart number 1 is the Nasdaq Composite. We talked about this potential inverse head and shoulders pattern, what's called a head and shoulders bottoming pattern. I would caution you on thinking too early that that's what's happening, because it's really not a valid pattern until we break the neckline. And that's why these areas that I'm highlighting, 14,500 would be the high from February. Really, the neckline would take you right to the 200-day moving average, around 14,700. The Nasdaq Composite gets above that level. This all of a sudden becomes a valid bottoming pattern that would measure at least to new highs, or at least back to the previous highs from November. So it could be a bullish chart, but this would have to be a higher low, and we'd have to get above those highs yet. I'm not seeing that happening in the charts just yet. Chart number 2 is the S&P 500, really the spiders, the SPY, using on-balance volume. One of the concerns I've had, and many have had about this market in recent months, is just the lack of volume support, right? And if you look here, these big red bars are down days on heavy volume. The lower green bars are lighter volume on the up days. A downtrend is usually characterized by heavier volume on the down days, because that's when the selling is really taking control, limited buying on the up days, and so the volume on up days is a little less. Now you can aggregate that sort of volume using something like on balance volume or accumulation distribution, some of those different indicators that we have on our platform. The on balance volume peaked in November and has been trending downward since then. We may be mounting a bit of a recovery here on the OBV, on the on-balance volume, but not enough yet, I think, to turn constructive on this chart. Finally, in our segment bottom line, we talked about Netflix and some of the other names reporting earnings. On earnings, I think it's a really important time to look at the chart, because it tells you the investor psychology or the sentiment going into the earnings release, but it also tells you about the behavior of investors afterwards. Netflix certainly getting a big hit after disappointing investors yesterday after the close. Now we're in we're in the ballpark of those lows from a couple of years ago. I pay attention to that green shaded area and see if Netflix can regain that watermark. Folks, that's our show for today. I want to thank you so much for joining us every weekday after the close for the final bar. Special thank you to Javed Mirza from Canaccord Genuity in Toronto, sharing a great long-term perspective with us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.